Well, here we go, DraftKings Q4, a bit of an earnings review. I know this has been highly requested, and today we'll go through the DraftKings earnings, some of the stuff that was said, some of the press release, some of the conference call and everything like that. I've tried to put as much detail in as possible, yeah, we'll get through it. So DraftKings Q4, overall, a pretty good smash for them. I've given it a 9.5 out of 10. It was a triple beat, the EPS was a beat, the revenue was a beat, and the outlook was raised as well, so really good. EPS, I was really surprised by that because quite often with a growth stock and a company like DraftKings, EPS are very easy to miss, and to them actually it wasn't a massive beat, but just to be in the right range was actually pretty impressive. So that was good. Revenue was a huge beat. I think they were beating expectations by like 8%, which is absolutely amazing. I did say that I think I did a bit of a preview on, I think it was Sunday or Monday. I said that basically this number here, I think is up for, because you're coming into DraftKings' Q4, which is kind of the peak season with like the NFL season starting. Obviously Q1's normally quite decent as well because you get the playoffs and the Super Bowl as well. But coming into the Q4, we're expecting quite decent numbers, and I looked at the analyst expectations and what DraftKings have been putting in, and I thought, they could easily beat what the number projection is here, and they did. The revenue was actually so good, and some of that as well, there wasn't actually, I think the hold was pretty poor, I believe, in October as well, so if you actually had 3 months of the holds being decent or okay, then it could have been even more, which is great. So yeah, really good numbers overall. And now getting on to kind of the share price point of view, I guess what I always try to do when I go into earnings is I try not look at the share price before going into earnings or after it, before I look at them, because I feel like if you have a share price that moves up, that might affect you when you're reading that earnings report. And if you have a share price that moves down, you might come into that earnings report a bit negative. So I always like to go in with a neutral point of view, so I don't let the share price kind of take my look on it. And like I said, I thought the earnings were really good. I did have the expectations going into this earning, judging by what kind of obviously growth stocks are really negative. A lot of them are beaten down. You look at a lot of the growth stocks this week, whether it be like Roku, Palantir, there's been a few other ones. They brought earnings out this week. Some of them have brought decent earnings out. I think Dropbox was one. Dropbox brought their earnings out on Thursday, not as much as a growth stock, but they brought earnings out and their earnings were really good. And the stock dropped 7%. So, I went into these earnings reports going just generally because there's negativity out there and, against a lot of growth stocks and everything like that. I knew that even if DraftKings pulled out good earnings, there was a chance this stock kind of would drop 10%. The only problem I had was, okay, if they come out with bad earnings, how much is this stock going to drop? Is it going to drop, maybe 20%? That's what I was kind of thinking. So I looked at the earnings. I thought, okay, very good earnings, 9.5 out of 10. We'll talk about why I think that maybe the drop happened, but I generally think a lot of the part of it was just because it was just such a negative market. And for me, I did even know that if DraftKings had good earnings, it probably would still drop 10%, but it did drop 20%. But I mean, for me personally, I look at that reaction. I do think it's a massive overreaction. I think it's just, growth stocks negativity out there, the market that we're in. I was a bit thinking, okay, are we actually sold off that much that maybe potentially that we don't drop off earnings because so many people are being flushed out, but it still drops a huge amount. So yeah, I mean, I looked at the share price and I was really surprised. I knew there was potential even if the good earnings to go down, but I was really surprised to see it go down 20%. For me, I mean, the earnings for me, in my opinion, were a 9.5 out of 10. I do have two little things that I will talk about which I didn't think were, one of the things why I think it dropped, but also one of the things that I personally didn't like. But apart from that, everything else was fantastic. I mean, you beat your EPS, you beat your revenue, then you hike your outlook up, and the outlook is, it's getting to the point of view where the outlook is nearly getting to the point of view now that where they're upping it that much, that they're near what I was predicting for 2022. So the numbers they're putting in is absolutely fantastic. This is such high growth company at the moment. It's unbelievable. So getting on some more of the numbers, they did 47% revenue, which is really good. They did year over year 101% for 2021. 101%. That's right, 101% year over year growth for 2021. Unbelievable. This is the big thing, is DraftKings are going full into it, capitalizing on this TAM. This TAM is growing even faster than what people thought. The marketing costs, sure, are a little bit expensive, but it's turning into that growth, and that growth has a path to profitability, which we'll talk about in a little bit. The growth was unbelievably good, 101%. I mean, that's one of my fastest growing stocks that I own, and even this year, the revenue guidance is still very strong going forward. Average revenue per user. Once again, more people coming onto the platform, and the people coming onto the platform are using it more and more and more. And DraftKings, one of the big weaknesses DraftKings has had pretty much for the last I'd say the last few years really, since I've been investing in it for sure, is that the iGaming has always been weak. But even the iGame was moving good, the marketplace is expanding, and what's happening is more people are spending more on the platform. It's up 19%, which is absolutely great. 2022, all states profit or contribute profit, including Louisiana and New York. So that's pretty impressive. I had to double check that for a time just to make sure that's actually correct. So yeah, all 2022 states to contribute, including Louisiana and New York. So a lot of these states are, the game plan was always for these states to start contributing profit to, kind of a 2 to 3 year time frame. So DraftKings, for example, what they do is a new state comes on, they put a lot of marketing into that new state. And then as the months and the year kind of goes on, you have 2 points of marketing spend with DraftKings. So you have the point where you launch a state and you're like, oh, we're live now, come sign up, bet $100, get $200 in free bets, for example. So you've got that marketing expense, and then you have, okay, when it gets down to the NFL season, so the Q1 and Q3, when it gets to the NFL season, okay, the NFL's starting, come join us for, so many more free bets. So you basically have Q1 and Q3 that are expensive states, or the expensive quarters. And then after that, the marketing spend pulls back. And then within a 2 year, 3 year time frame, them states start contributing to profit. Now, the thing is that this is doing so well that contribution to profit is even coming quicker than the 2 to 3 year time frame at the moment, which is great. And they also said that if there was no new states after 2021, so obviously there is, because you've got Louisiana and New York that have just launched recently, but let's say DraftKings went, okay, we won't spend any more, we won't capitalize on the growth opportunity, we won't capitalize on the TAM. Let's just say, okay, we'll make people happy and we'll come like a profit company. If they had no new states after 2021, they would have been able to get positive EBITDA in Q4 2022. So the company basically came out and said, look, if you didn't want us to be growing at 101% and you want us to start showing, oh, can you actually start doing profit? We'll go, okay, we'll stop growing. We won't capitalize on New York. We won't capitalize on Louisiana. We won't capitalize on bringing our revenue from being 2 billion or what is at the moment 1.3 billion. We won't capitalize on that. We won't get the revenue up to 2, 3, 4, 5, in the future, maybe potentially 10 plus billion in revenue. We won't ramp up the revenue. We'll just take it down to profit. We could do it, but we're not. We want to capitalize on the TAM. So then when everything matures in the business, we have massive amounts of revenue turns into the profit. And this is it. This is DraftKings going, all those people that say we don't have a path to profit and we just burn money. We only burn money to capitalize on the revenue. That revenue burn, or the burn in the marketing, is proven to come to profitability. We could have done it if we wanted to, but we're going to carry on expanding. And that was impressive. They also said we will be positive EBITDA in Q4 2023. So this is, when you think about it, that's not actually too far away. It's just short of a 2 year time frame. In my head, I did think that around about the 2 year mark is when in 2 years time, DraftKings would potentially get very close to break even. So I am very happy with that, because for me personally, I do like to see at some point when I invest into a company that it isn't too far off profitability. So obviously that will, if they do get to positive EBITDA, they will be very close to probably getting towards profitability, which is great. And also doing that, they'll still be growing, should be growing at a really good rate. Obviously that is including that is that as if states open up on the same rate that they are doing at the moment, which is important to say. So if there's a big explosion of states that come online, then obviously that won't happen because they'll spend more on marketing, for example. But if there is less states that come online than what they were expecting, then that will actually be quicker. They didn't say that on the conference call, but that is something to actually consider that I thought about. I thought this was the biggest thing in the earnings call, I think, for me. 5 states contribution to profit. So this year, 5 states have contributed to the profit, which is impressive. So only a year ago, maybe not even a year ago, 9 months ago, March time last year, we got the first kind of signs of, okay, this business actually has a path to profitability. There's a lot you've always got. I'm going to get it on this video. There's a lot of negativity out there at the moment with growth stocks, and especially growth stocks that don't make money. And one attack that DraftKings always has is that it doesn't make money. But in March 2021, DraftKings kind of went, yeah, we can make money, because they announced that New Jersey, their longest state that's been open, is started to contribute to profit. And you're like, okay, that is proof that these states can get to profit. And what we kind of had Jason Robbins drop a couple of hints of is that towards the start of next year, which I thought was going to be the investor day, which is which they are going to give more detail on this, but that was going to be that's in a few weeks' time. It was kind of like, okay, there's going to be more states maturing. Obviously, New Jersey's matured quite a bit now, but all the states that was kind of launched in maybe 2019, maybe 2020, a lot of them states will start getting to contribution profit if the timeline is correct. And I thought right now we'd probably get an update saying that 2 or 3 states are now contributing to profit. We're up to 5 states, which is really good. It's the profitability for them states are coming in even faster than what I thought they would be, which is absolutely amazing. Like I said, it shows the game plan that these states that they kind of go into, spend heavy on marketing and then let it mature, it comes to profit, and their kind of 2 to 3 year time frame to kind of get the profitability or them to pay back all the marketing happens. This was just more evident. This wasn't a one state fluke. It's nearly all the states still following the same pattern of maturing, and they start contributing to profit, which is really good, way ahead of what I thought. The thing is the sports betting, the TAM's just increasing. They said that the thing is that the TAM at the moment is moving faster than what we ever thought it would, and it's just getting a bigger marketplace. And as long as DraftKings come round and hold 30% of the share of the market, it's going to be a fantastic company. And the thing is, Jason Robbins as well, he is a really good CEO and founder. Like, he knows that he doesn't stay still, he expands the business still. The DraftKings isn't just going to be a sports betting company. Obviously, it's got the sports betting and iGaming and stuff like that. I mean, look at the marketplace. They're starting to work on the marketplace right now. That could be something special. They're starting to build out a media platform. Jason Robbins is a really good CEO. I really do like him. He doesn't just think, okay, what can we do now? What's it going to be further down the line? What can we build into the platform to make more income streams? And that's what I like about Jason Robbins. He is thinking, okay, I don't want to just be DraftKings, the sport betting company. I want to be DraftKings that is the umbrella of things, that own all these things. And obviously the TAM's growing faster, and also with a CEO like him in place, he is thinking about the next opportunities, which is great. One key thing that was asked, obviously at the moment DraftKings is burning through a fair bit of cash. They did say that because we're in the next kind of not next year will still be quite a high cash burn year, but when we start getting towards 2023, that cash burn is starting to shrink down a massive amount, and because of that, they do have a lot of cash on the balance sheet, and they will not need cash if they want to carry on expanding. The company should be self-funding. Now, obviously, I think that if the time comes right and let's say the shares do well, or they see an opportunity to maybe buy someone, then obviously they potentially could raise some form of cash. I don't think it's absolutely ruled out, but if they stayed at this kind of time frame, they and everything kind of follows the plan, they won't need any cash, which is good. So yeah, overall, I mean, there were so many positives. I ran out of room on the whiteboard to put any more in. But I thought I'd talk about 2 of the negatives. So obviously the stock was down 20%. A lot of people focused on this. They said that Analyst did not like the EBITDA forecast. So the forecast was 825 million loss to 925 million loss. Now, this is a big confusing thing for me, because DraftKings have never actually, as far as I'm aware, since I've been a shareholder in DraftKings, they have never actually forecast EBITDA, but this is the first time they've done it, just to kind of give some context on what's going to go on in the year. So I don't know how analysts weren't happy with the forecast when they've never had a forecast, and that there was some sort of analyst expectations on the forecast, because I don't know why there was forecast on the expectation, because they never give the numbers. So I was like, well, why would you make a forecast if they've never historically, brought the numbers out? It just sounded really confusing to me, like, on that. And the adjusted EBITDA was, I would say it was a little bit higher than what I thought, but it wasn't too much higher. I did think it was going to be in this range. According to Analyst, it was 125 million more than what was expected. But I want to say is, like, DraftKings never do it. DraftKings are really bad on not really bad on the forecast, but this business will change so much in the next 12 months because they don't know which states are going to come online. And if more states come online, what's going to happen is they're going to obviously increase marketing and expenses. So what will happen here is if there's more states online, DraftKings is going to increase their outlook. But because they're also going to expend more on the marketing, then obviously their EBITDA will probably go lower down. So this could change. So even though they give these forecasts, they can change quite a fair bit. So I won't say this is concrete what they're going to do. But I mean, it has to be done. You've seen the benefits of, like, more and more states now. It proves that the marketing spend is justified because they do start contributing profit, which is great. So it will change, and yeah, it's 125 million now. And what I'm going to say as well is, like, the thing is that what was also evident is that, a lot of these states that are starting to contribute profit now, 5 states that contribute profit, these states don't go from states that grow, 100% a year and then go down to like 5% a year. These states right now, like New Jersey was still like, growing their revenue and user acquisitions at a massive amount. So this is the big thing, is that, a lot of these, these investment they're making still then isn't going to end up being a massive slowdown. A lot of these states, even though they start contributing profit, are still growing at a really, really fast rate as well. So obviously it's fantastic. The only little thing that I didn't personally like, I wasn't bothered on the EBITDA forecast. Because, I mean, it can easily go out the window depending on state launches as well. So I wasn't too massively bothered on that. And obviously, with a company like DraftKings, it's focused on the hyper growth stage. It's growing 101%. It's focused on taking market share. You don't want them to become a profitable company. You want them to kind of capitalize on the TAM, and that will mean more profit further down the line. So I wasn't too bothered on that one. And like I said, I wasn't really expecting an EBITDA guidance from them because they never do it, as far as I'm aware. The only negative that I did have was the share comp. The share compensation was it is getting a little high. I would like them to kind of control that a little bit more. That is probably one of the big things that is contributing to the losses as well. Obviously the EBITDA is negative, but the share compensation is very high. Now I don't mind them doing it, obviously, and obviously you're going to reward people that are doing very well in the business. And people say, oh, you shouldn't be getting share comp because look at the share price. But I mean, that's stupid, because you want to be looking at the business, and you look at the business DraftKings have delivered in 2021. They've just put 101% year growth in. They've started to get more and more states to profitability now. Obviously the company's on absolute fire. So I do, if you want to have the best people in the game to work for your company, to kind of develop the company, you want to, keep them happy and keep them there. I do look at the share comp though, and I go, it has increased a massive amount over the last 12 months, and I do feel like that is something that does need to get controlled, because that is a bit of a sly way of annoying the shareholders. Like we don't mind you rewarding for hard work and working for the business and keeping everyone happy, but there's a point where you are share comping ridiculously, and I felt like when I looked at it, it was quite heavy this time round. In this year overall, I think the quarter in general was heavy, but overall it's built up across the year. So I mean, that's something for me that going into the next year, I would like them to control a bit better. So we'll see what happens there with that one. But that was the only negative I have. If it wasn't for that, and it was down, even if it increased, but not increased as much as what it did, I'd probably have given this earnings 10 out of 10, but that was probably the only negative that I had with it, that keeps increasing at such a rate. But overall, I thought the earnings were really good. I think obviously it did go down because I thought this was a massive overreaction. I think down 20% was, it's a huge dip, And like I said, the trading update in general was it was pretty solid. There's a lot of positive news in there. I did expect it with how negative market that we're in, that it would probably drop even if the earnings are good, which they were. But to drop 20%, I would expect a drop of 20% if the earnings were negative. I would expect a drop of 20% if they missed the EPS, the revenue was only in line, and they didn't raise outlook or something. That's where I'd probably justify a 20% drop. But if we weren't in a negative market, I would expect these earnings to probably see the stock up a good, potentially, especially with the prices that it's at, I'd expect at least a double-digit jump on the share price with these earnings. They were really, really good. So yeah, overall, I'm a happy shareholder. Everything's going in the right direction. In fact, everything is even going better than what I thought, which is obviously even better a situation to have. And one of those where you actually start running your numbers and you're going, okay, this could actually be better than the numbers that I predicted, which obviously would then return even higher upside as well. So yeah, pretty good. Hope you enjoyed it. Little recap of earnings. Let me know what you thought in the comments. Maybe give a score out of 10. That'd be pretty cool. And I'll catch you in a bit. Have a good weekend. I'll probably see you on Monday.